Now let's move on to our next keynote address of the day, which is on the Indian economy and the banking sector. And to deliver this address, I would request Mr. K.K. Mistry, who has been at the helm of affairs as a strategic advisor and independent director with various companies and has also served as the vice chairman and CEO of HDFC Limited, to take the stage. Over to you, sir. Can we have a big round of applause?
Well, good afternoon, everyone, and it's a great pleasure to be here today. I'd like to thank Dun & Bradstreet for inviting me to speak to all of you. In today's address, I'd like to talk about my views on the Indian economy. I will also share my perspective on India's immense potential, including in the financial sector. The financial sector has significant potential for growth as it remains hugely underpenetrated. The financial sector will play a crucial role in leading India's growth story, as finance serves as the backbone of any economy anywhere in the world. Against the uncertain, let me first start with the global environment and then I'll come to the Indian environment. Against the uncertain global backdrop, India has increasingly been in the spotlight for being the fastest growing major economy. I'm extremely optimistic about the future of the Indian economy. India's economic growth has surpassed global expectations as it was better able to manage its economy due to a confluence of factors such as sound government policies, strong macroeconomic fundamentals, inherent domestic demand, an extremely successful vaccination drive during the COVID period, timely regulatory interventions, and continued reforms which have ensured India's long-term growth. In recent years, India's economic growth has surpassed expectations. At the onset of COVID-19, RBI was proactive with its monetary easing and liquidity support. RBI needs to be commended for the host of measures it introduced, particularly during that period and even subsequently thereafter. During the peak of the COVID crisis, in order to augment liquidity in the system, RBI reduced the reverse repo rate, cut the cash reserve ratio requirement, conducted targeted long-term repo operations, and introduce refinancing facilities for financial institutions. The gradual lifting of the lockdown restrictions by states saw both demand and consumer confidence come back slowly from September of 2020. There has been no looking back thereafter, and for the current year, which is for 23-24, RBI and the government have increased the GDP target for the year from 6.5% to 7.3%. Foreign investors acknowledging India's growth prospects as India as an emerging market clearly stands out. The IMF has estimated India's GDP growth to be 6.7% during the year, which will ensure that India remains the fastest growing large economy in the world. In my view, the IMF is underestimating India's growth, and we should end up with a much higher number. The onset of the Russia-Ukraine war saw spiraling oil prices, and inflation started hitting the Indian economy from April of 2022. RBI reined in inflation through a series of calibrated measures. RBI has increased the repo rate by 250 basis points since May of 2022, and currently the repo rate stands at 6.5%. To further contain inflation, RBI is focused on withdrawing excess liquidity in a gradual and non-disruptive manner. As a result of such measures, average surplus liquidity has fallen steadily from 7.8 trillion in January-February of 2022 to a liquidity deficit currently of nearly 2 trillion rupees. Core inflation has largely been reined in and stood at 5.1% in January of 2024. This shows that RBI's disinflationary monetary policy is working its way through the economy. The Finance Ministry needs to be commended for not becoming overzealous in a stimulus package during the pandemic. If India had not kept the fisc in check during the pandemic, inflation levels could have been out of control, as we witnessed in several countries, particularly in the Western world. In my opinion, both the government as well as the RBI did a truly outstanding job in managing the economy during these last 4 years, and this has contributed, in my view, in a significant manner in making India the fastest growing major economy in the world. I truly believe that there is no better place than India to be in right now. I talk to international investors regularly, and during my interaction with them, the feedback about India is extremely positive. The image of India has improved by leaps and bounds, and a major part of the positive image stems from the efforts being made to improve the business environment by bringing in greater transparency through a stable and fair regulatory regime. India as an emerging market clearly stands out from the others. Foreign investors are acknowledging India's growth prospects and are appreciating the policy measures that are being implemented. These policies are aimed at improving the day-to-day lives of people and capitalizing on geopolitically triggered shifts wherein India can become a preferred destination in the supply chain of major global companies. There is also a huge thrust on digitization across all sectors of the economy, particularly the financial sector. There are several important indicators which reflect India's strength in the global economy, and there is no other economy that currently has the capacity to absorb the scale of investments that India can or has the growth potential that India offers. I would like to highlight just some of these positives. Firstly, India has favorable demographics. India accounts for 17% of the world population, or 1 out of every 6 person in the world is an Indian. More importantly, 66% of this population is below the age of 35. India's middle class is estimated to rise from 250 million individuals currently to about 800 million by 2030. India is a domestic consumption-based economy. Private consumption forms close to 60% of the economy. According to a report by Morgan Stanley, India will become the third largest economy by 2030. It is estimated that the number of households with incomes in excess of rupees 30 lakhs per annum will rise fivefold to 25 million by 2031. Further, the per capita income is expected to rise from US dollars 2,300 currently to US dollars 5,200 by 2031. Thirdly, India is poised to become the third largest consumer market behind the US and China. Consumer spending in India is expected to grow from $1.5 trillion at present to nearly $6 trillion by 2030. There is strong growth in highway frequency indicators such as e-way bills, railway freight, highway toll collections, and GST collections. For example, GST collections grew by 10% year on year to 1.72 trillion as of the last count. And GST collections have now been over ₹1 trillion for 31 consecutive months. The government has kept the fiscal deficit under control. For financial year 2024, India's fiscal deficit target has been revised downwards to 5.8% from the earlier estimate of 5.9%. And according to the finance minister, the budget deficit is expected to further moderate to 5.1% for 2025. One needs to commend the government for not introducing populist measures during an election year. India's external debt is extremely manageable at 18.6% of the GDP and is the lowest amongst major emerging markets. Bank credit in India has picked up over the past year and has remained in double digits since April of 2022. As of December 2023, the overall bank credit grew by 15.6%. Retail credit growth was strong as well, with personal loans growing by 17.7% and housing loans by 14.4%. Whilst deposit growth has not picked up with the same pace as credit growth, banks are intensifying their deposit collections to meet the demand for credit. The Indian banking system has been very resilient. Since March of 2021, there has been a continuous steady decline in the level of NPAs. NPAs have declined from 7.3% in March of 2021 to a decade low of 3.9% in March 2023, and as of September 23, NPA levels have further improved to 3.2%. The balance sheets of the corporate sector are now significantly stronger with lower level of leverage than what they used to be. The RBI is being acknowledged globally for its extremely effective supervision of the Indian financial sector and for guiding economic growth without the high inflation that Western countries are facing. The RBI has been extremely proactive. In November 2023, RBI increased the risk weight on unsecured consumer loans by 25 basis points for banks and NBFCs to prevent any possible systemic risk that these type of loans could pose to the system. India's foreign exchange reserves are at a very comfortable level of about $622 billion as of early February 2024. This covers about 11 months of imports, and this makes India the fourth largest holder of reserves behind China, Japan, and Switzerland. Further, India achieved record remittances from non-residents, which amounted to about $107 billion in financial year 2023, and in the first half of financial year 2024, inward remittances had crossed about $48 billion. The RBI has intervened time and again to support the rupee so as to contain volatility and ensure orderly movement of the currency. Measures are being implemented to ensure macroeconomic and financial stability. Over the past 1 year, the rupee has been stable and has been in the $82 to $83 range. Until February 15th of 2024, rupee has depreciated by 0.4% against the dollar on a year-on-year basis, compared to a 5.1% depreciation for the Chinese yuan. Financial penetration in India is extremely low. In fact, it is truly very, very low. And this implies a huge potential for growth. For example, the mortgage to GDP ratio in India is 11% compared to between 20 and 30% in most East Asian countries, 69% in the UK, and 52% in the US. Insurance penetration in India stands at 4.2% of GDP compared to a global average of 7% of GDP. Similarly, India's mutual fund penetration stands at 16% of GDP compared to 149% in the US and 75% in the UK. This means that with a population of over 1.4 billion people, barely over 2% invest in mutual funds and equities. The potential to grow, therefore, is enormous. There is a huge potential for more youngsters to become patient long-term investors in equity and mutual funds, and we have really started seeing that in a big way in the last couple of years. We are moving in the right direction. In 2014, the combined assets under management of all mutual funds hit the 10 trillion rupee mark, and in just 3 years thereafter, in 2017, it doubled to 20 trillion. And as of January 2024, the assets under management of mutual funds touched an all-time high of 52.7 trillion rupees. Interestingly, 57% of the industry investor base is retail. Indian equity markets are the most favored amongst emerging markets. For instance, over the last 12 months, till February 15, 2024, Indian stock markets have grown by between 17 to 20%, depending on which index you are looking at, while Shanghai had a sharp decline of 12% during the same period. It took the Bombay Stock Exchange Sensex 21 years from 1986 to 2007 to touch 20,000 points. From February 2020, that is a month before the pandemic, till now, the BSE Sensex has increased from 40,000 mark to close to 72,000 marks currently, 72,000 points currently, which is an 80% increase. While the increase in penetration of smartphones and with the internet connections facilitating ease of doing online transactions, there has been a sharp increase in demat accounts from 40 million in financial year 2020 to 139 million currently. This is nearly 3.5 times increase. This financialization of savings augurs well for the Indian economy. Flagship government programs such as the JAM Treaty, which is Jan Dhan Yojana, Aadhaar, and mobile technology have helped in implementing direct benefit transfers on a massive scale. The introduction of a unified payment interface that allows customers to make digital payments using a smartphone is helping India to transform into a cashless society. UPI is the most preferred payment product by volume, accounting for 75% of the total transactions in financial year 2023. According to a report by PwC India, UPI will achieve a milestone of 1 billion daily transactions by financial year 2027. Lastly, India is expected to be a $1 trillion digital economy in financial year 2027. This will be 1/5 of the total economy at that point of time. I will address the fintech's industry a little later. I do believe that India's pace of reforms will continue. Sound regulatory policies and implementing structural reforms will help India attain even faster economic growth. The one key factor, the one key challenge that we face in our growth is our dependence on oil. The trajectory of oil prices therefore becomes extremely critical in determining India's growth. India imports nearly 80% of its oil requirement and is the third largest importer of oil in the world. And according to some arithmetic, I saw some statistics from CII, a $10 increase in oil prices reduces GDP by between 30 to 40 basis points. A 10% rise in crude prices puts 20 to 25 basis points upwards risk on inflation. And for every $10 increase in oil prices, inflation is estimated to increase by 37 basis points and current account deficit by close to 30 basis points. Thus, the trajectory of oil prices is a very critical aspect in India's growth story. India's inclusion in the Global Bond Index will immensely help strengthen the rupee over the long term. India will be included in the JP Morgan Global Bond Index. This will be effective by, I think, June of 2024 and would in all likelihoods also get included in the Bloomberg Global Aggregate Bond Index. There are various estimates that India's inclusion in the global bond indices will attract amounts to the range of about 25 to 30 billion US dollars annually to begin with and rise to about 50 to 60 billion US dollars subsequently. According to estimates by Morgan Stanley, India's bond inclusion could attract foreign investment of between 170 to 250 billion dollars over the next decade. And higher FPI flows in India's debt market have many advantages. Some of them will be: one, greater demand for Indian government securities, which will lead to higher prices and lower yields. This will result in cheaper government borrowing. Secondly, it will help the government to fund more infrastructure projects, which will result in more jobs getting created. Thirdly, corporate bond yields will come down as they are benchmarked with G-SECs. And fourthly, more flows into government bonds will mean more liquidity available for banks to lend. So let me conclude my talk by saying that the macroeconomic fundamentals in India remain very strong. Consumption trends will sustain, and India should continue to leverage its strength in technology. I expect the reform process to continue in the months and years ahead. An extremely strong government focused on growth, a well-regulated system, and enormous growth opportunities in the economy make India the perfect destination for foreign capital. India is continuing to climb up the growth ladder, and I personally remain extremely optimistic about India's economy. India is a strong domestic consumption-based economy, and penetration levels are so low in India that the scope for businesses to grow is truly immense. Several global industry leaders have unanimously said that India is probably the most attractive destination for foreign investment. India's young population offers a great opportunity for growth. In that sense, we are less dependent on global factors than most other countries. Thank you very much.